Wait, investing is not only for the rich. You do not need a huge amount to begin. You need a plan, a habit, and time in the market. In this guide, I will show you how to start with $100, how to grow with $1,000, and how to build a diversified portfolio with $10,000. I will explain what each tool is, how to open an account, how to place a simple order, the pros, the cons, the risks, and realistic expectations. By the end, you will know exactly what to do next. Before we talk about investing, handle two basics. First, kill high-interest debt. If a credit card charges you 15 to 30% a year, no safe investment will beat that reliably. Pay it down first. Second, create an emergency fund. I'm for 1 to 3 months of basic expenses to start. Keep it in cash or a high-yield savings account. This is not an investment. It is a safety net that keeps you from selling investments at the worst moment. Now, let's start with $100. $100. The goal is not to chase magic returns. The goal is to build the habit and learn the mechanics. You can buy a broad market ETF. An ETF is an exchange-traded fund. Think of a basket with many stocks inside. When you buy one share of a broad market ETF, you own a tiny piece of hundreds of companies. That gives you instant diversification. You can also buy fractional shares. Many brokers let you buy $5, $10, or $50 of an ETF, even if one whole share is more expensive. That removes the barrier. What to expect from a broad stock ETF? Over long periods, stock markets have delivered positive average returns, but not every year. Some years are up a lot. Some years are down hard. Over decades, average annual returns have often been in the single digits to low double digits before inflation, but they vary widely. There are no guarantees. The price will move every day. That is normal. How to actually buy your first ETF? Open a brokerage account. The process is similar across countries. You provide your name, address, ID, and tax information. Enable two-factor authentication in the security settings. Fund the account with a small bank transfer. In the search bar, type the fund's ticker. Press buy. Choose market order if you want to purchase immediately at the current price, or choose a limit order if you want a specific price. Start with a small amount. Set up an automatic contribution every week or every month. This is called dollar cost averaging. It takes emotion out of the process. With $100, you can also try a low-cost bond ETF. Bonds are loans to governments or companies. They pay interest. Bond funds usually move less than stock funds. Potential returns are lower, but the ride is calmer. Another option for small money is a REIT ETF. A REIT is a real estate investment trust. It owns properties like apartments, warehouses, or offices and pays dividends. Real estate can diversify a portfolio, but prices can still swing. You can consider cryptocurrency, but only as a small slice. Crypto is extremely volatile. The price can double or fall by half in a short time. If you want exposure, keep it small, like 5% or less at this stage. Your core should be a broad stock ETF. With $100, a simple plan looks like this. Put 80 to 100% into a single broad market ETF using fractional shares. If you want a calmer mix, try 70% stock ETF and 30% bond ETF. Reinvest any dividends automatically. Add small amounts on a schedule. The habit matters more than the amount. Common mistakes at $100. Jumping in and out because of headlines. Buying hot tips from social media. Putting everything into a single speculative coin or stock. Forgetting fees. Your job is to keep it simple and consistent. Learn how orders work. Learn how statements look. Build a routine. Now let's talk about $1,000. With $1,000, you can build a small but complete portfolio. You can mix stocks, bonds, and real estate, and you can hold a small cash buffer for the next buy. You can also add a specific theme if you understand the risk. A balanced starting point for $1,000 could be 60% in a broad global or domestic stock ETF, 20% in investment-grade bond, 10% in a REIT ETF, and 10% in cash, ready for your next scheduled buy. If you prefer more growth, make it 70% stocks, 15% bonds, and 15% REIT. If you prefer more stability, make it 40% stocks, 40% bonds, and 20% REIT. These are not magic numbers. They are training wheels that keep you from over-concentrating. Let's define these tools more clearly. A stock ETF tracks an index like a group of large companies. It can be domestic or global. The expense ratio is the annual fee. Lower is better over time. A bond ETF holds many bonds and pays interest to the fund, which passes it to you. Bond funds tend to cushion falls in stocks, but they can also drop when interest rates rise. A REIT ETF holds companies that own property. They pay dividends, but they also rise and fall with the economy and interest rates. What could $1,000 become? If you add $100 each month to a diversified portfolio and the long-term average return is moderate, the balance can grow meaningfully over 10, 20, and 30 years. The exact number depends on returns and discipline. The key idea is compounding. Gains on top of gains. The earlier you start and the longer you stay, the larger the effect. How to operate month to month. Automate contributions on payday. Buy the same funds every time. This is dollar cost averaging. It buys more shares when prices are low and fewer when prices are high. Once a year, check your allocation. If one part grew too large, sell a small slice of the winner and buy the laggard to return to your target mix. This is called rebalancing. It keeps risk in line. You can also hold a small position in individual stocks that you believe in. Treat it as a satellite around your core. For example, 90% in funds, 10% in funds, 10% in a single company or the me you know well. Do not flip positions weekly. You are building wealth, not trading for adrenaline. Consider taxes at a basic level. Many countries tax dividends and capital gains. Holding for more than a year may reduce taxes in some places. Using tax-advantaged accounts, if available in your country, can improve outcomes. Keep records. Ask a local professional if unsure. This video is education, not personal advice. Psychology matters more than math. At some point, your portfolio will drop 10%, 20%, maybe more. That is part of the journey. The worst thing to do is panic sell near the bottom. Create rules now. For example, I will keep buying monthly unless I lose my job. Or I will only rebalance once a year. Rules protect you from your emotions. Let's move to $10,000. With $10,000, you can diversify across regions, asset classes, and even strategies. You can hold a core of broad stock ETFs. You can add small caps or a technology sector fund if you want more growth. You can balance with bonds of different maturities. You can hold a REIT allocation for real estate exposure. You can hold a small slice of commodities or gold as a hedge. You can keep some cash for opportunities. You can also fund education or a small business, which are investments in your earning power. A simple, diversified layout for $10,000 could be 50% in broad stock ETFs across domestic and international markets, 20% in bond ETFs with different maturities, 10% in REITs, 10% in a sector or factor if you understand, 5% in cash for buys on dips, and 5% in a hedge like gold. If you prefer growth, raise stock exposure and lower bonds. If you prefer stability, do the opposite. The mix should match your time horizon and your ability to sleep at night. At this level, you can think about factor funds. Some funds tilt toward value, quality, or dividends. They may behave differently in different markets. You can also consider a small position in emerging markets for diversification, knowing they can be more volatile. If you own individual stocks, set a maximum position size. For example, never let a single company exceed 10% of the portfolio. This reduces the damage if one story breaks. If you are attracted to real estate beyond REITs, understand liquidity. A property can be a good long-term asset, but it is not easy to sell quickly. There are maintenance costs, taxes, and vacancy risk. Do not put all your liquid savings into a down payment if you have no buffer. A fund that owns real estate is easier to buy and sell. The difference between a low-cost fund and a high-fee product compounds over years. Always check the expense ratio. Always check trading and custody fees at your broker. Lower cost leaves more return for you. Security matters. Turn on two-factor authentication. Use a unique password. Beware of phishing emails. Never share your recovery codes. Scams in finance are common. If something promises guaranteed high returns with no risk, it is almost surely a scam. Let's build simple step-by-step checklists you can follow today. Choose a reputable broker in your country. Read the fee table. Open the account with your ID. Enable two-factor authentication. Transfer a small amount. Buy a broad stock ETF using a market order for simplicity. Turn on dividend reinvestment if the broker supports it. Create an automatic monthly transfer from your bank to the broker. Decide your target mix. Write it down. Put a reminder on your calendar to review once a year. That is your whole system. If you are starting with $100, your checklist is even shorter. Open account. Fund $10 to $50. Buy a fractional share of a broad stock ETF. Repeat every week or month. When your balance grows above 500, consider adding a small bond fund. When it exceeds 1,000, begin using the $1,000 plan. If you are at $1,000, choose a mix that matches your temperament. A simple default is 60% stock ETF, 20% bond ETF, 10% REIT ETF, and 10% cash buffer. Automate monthly buys. Rebalance once a year. Increase your contribution when you get a raise. Upgrade your savings before you upgrade your lifestyle. If you are at $10,000, decide your role. Do you want pure simplicity? Then hold two funds. One broad stock ETF and one bond ETF. Do you want a bit more control? Then add real estate, a sector tilt, and a small hedge. Do you want to learn businesses? Then keep a small slice for single stocks, but cap the size and avoid leverage. Write your rules. Follow them when markets are noisy. A word about dividends. Some funds and stocks pay cash distributions. You can take them as cash or reinvest them. Reinvesting accelerates compounding. Income strategies feel good, but do not chase yield without understanding risk. A very high dividend often signals a weakening business or a high debt load. A word about timing. People try to buy bottoms and sell tops. It sounds smart. In practice, it is very hard. Missing only a few of the best days in the market can severely reduce long-term results. A boring plan that you can stick to is better than a brilliant plan you abandon. Time in the market beats timing the market. A word about inflation. Inflation slowly erodes the value of cash. That is why long-term goals require assets with growth potential. But cash still has a role. It is your shock absorber. It pays for emergencies. It lets you buy when markets fall. Hold enough to sleep well, but not so much that your future shrinks. A word about education. The best investment for many people is in their skills. A short course that raises your income can beat any fund. If your budget is tight, spend part of your investing energy on learning. Higher income gives you more to invest every month. That is the real engine of wealth. Let's tie the three levels together. With $100, you learn the mechanics and build the habit. With $1,000, you create a resilient mini portfolio and automate growth. With $10,000, you diversify across the world and across asset classes, and you write rules that keep you steady. At every level, you avoid high-interest debt. You keep an emergency fund. You invest on a schedule. You ignore noise. You let compounding do the heavy lifting. If you remember only 5 rules, remember these. Start now, even small. Automate contributions. Diversify with low-cost funds. Rebalance once a year. Do not panic sell. Do these for years, not weeks, and the results will surprise you. Now, choose your level. If you have $100, buy a fractional share of a broad ETF today. If you have 1,000, set a simple mix and automate buys. If you have 10,000, write your policy and diversify with intention. Then live your life and let time work for you. Your pathway to profit is not a secret. It is a set of small, repeatable steps. Start today. Let's talk expected returns in plain words. Stocks have the highest long-term potential but the wildest ride. Bonds have lower potential but smoother paths. Real estate sits between them and pays income. Cash feels safe but loses purchasing power when inflation is higher than interest paid. Crypto can skyrocket or crash. It is speculation. Use it, if at all, as a tiny spice, not the meal. Fees matter.